The Polestar stock has been the topic of many conversations lately, and in today's video we're going to look at the price actions, the recent developments, the technicals, and my opinion on if you should be buying the stock. As the market is very volatile at the moment, we should be mindful of which positions to pick, as well as their individual timing and exposure. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Over the past few days, the price action of Ggpi or Polestar has brought the stock to around $10.11 before stabilizing around $10.26. So far, Polestar was able to hold its ground at $10 mark, which is a psychologically important and significant level for investors and the market at large, sending a signal that this is the floor, allowing investors to bounce back. In fact, if we take a step back, this is also likely the floor because the SPAC it's supposed to merge with has a reimbursement of $10 per share, and as long as the merger is not completed, this insurance will be there. Looking back, I believe that Polestar will be one of the more serious players in the field, with its own design, products, the fact that it's aiming at the high-end segment. One additional consideration is that Polestar is going public when the market is different from the one we used to see in 2020, when any EV stocks can jump up as long as the investors see the word electric vehicles in the description. I believe that Polestar will start trading at a relatively modest price, which gives enough room for shareholders to benefit from additional values. Now, let's take a look at the technicals of the stock. The trading volume of Polestar has recently been 2.1 million shares versus an average volume of 2.5 million shares. Over the previous 52-week period, the price fluctuated between $9.70 and $16.40. The trading volume is a metric that can tell you how many shares are being exchanged hands and whether there is a lot of activities and attention on the stock. It often gives you a first idea about the popularity of the company. When we use it to compare with the average volume, it can also tell us if the company is enjoying additional momentum to reverse its trend or to break through current resistance levels. Even when the current volume is lower than the average, this can be an interesting indication nevertheless because it can signify that a trend reversal may happen soon. The market cap of Polestar is currently at $1.1 billion compared to the enterprise value of $1.1 billion. To put simply, the market cap is the fair market value of the company based on the current market sentiment, the company's reputation, and other macroeconomic factors, whereas the EV or enterprise value is usually the cost the company has already spent for its assets after paying off all the debts. It's worth mentioning that one of the most significant assets for a lot of growth companies may be intangible, which means that they're not items or inventory that the company can use to generate income, but secondary item that may provide growth potentials for the future, such as pledges for major contracts, blueprints for new products, and schematics. For startups, most of their valuations are based on the intangibles, and for a lot of companies, they were valued in favorable market conditions. In concrete terms, this means that there can be a huge difference between the market cap and the enterprise value, given a false impression to the market participants that the company is trading at a discount. It's only trading below its book value, but it doesn't mean that the company itself is necessarily undervalued. It's also possible that the company itself was overvalued in the first place, and that this value has deflated since then. As we compare the current price to the historical price fluctuations, the stock is 2% higher than the 1-month low, 2% higher than the 3-month low, and 6% higher than the 52-week low. On the options market, which gives us a hint about the market sentiment on where the stock price is likely going to go next, the implied volatility is 88% versus a historical volatility of 23%. The put-call volume ratio is currently at 0.2. It's normal for many stocks to tend to have a higher put option volume than what they truly deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 5,000 contracts a day versus the 30-day average volume of 8,000. In terms of open interest, the most recent volume of open interest is 228,000 contracts versus a 30-day average of 270,000 contracts. The option contract is a derivative from the underlying security, giving participants the possibility to have a right to either buy or sell the security at a predetermined strike price. Buying the contract would give you the right, and selling the contract would give you premiums, with an obligation to execute the contract if the counterparty chooses to do so. It is often said that you can evaluate the likely scenario based on the opposite of what the current ratio is. If there's a lot of put options, then there may be possible uptrends on the move, or a reversal may happen if there's a lot of call options. The reasoning behind that theory is quite simple, because most options expire worthless. For the shareholder structure, institutional owners hold about 21% of the outstanding shares. The biggest shareholders include BNP Paribas, Millennium Management, and Citadel. It's relevant to understand the shareholder composition of a company because it helps to determine whether you should hold the stock long-term or to view it as a trade opportunity. If the stock is mainly held by retail traders, this can be a sign that the stock lacks the depth to justify long-term trust from shareholders. Typically, the consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. There's obviously a lot of exceptions to this, since many great titles are also held by retail traders and not institutional ones, but that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes when there are significant short interest in the total volume, this can be a sign that there's an organized shorting operation going on, like what happened with GameStop and AMC. The current short interest is 10% of the total float and 60% of the transactions coming out of the dark pools. Usually, if the short interest is above 15% of the total volume and a significant chunk of it coming out of the dark pools, this may suggest that there are institutional positions taken to short the stock. I don't think that it is the case at the moment. My recommendation is to keep a position in Polestar and to hold it for the medium and long term. I believe that the current price may be located at the lower end of its market value or potential, so I would recommend to commit a larger portion of your allocation now and to save the rest for further averaging downward. I would recommend to commit between 3 to 5% of your portfolio in Polestar and would further recommend to split this allocation in batches of 40% at a time, or maybe 40% or 50% now and then 20% for later purchases. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.